There is a single number on a company's balance sheet that acts as a kind of financial X-ray. It cuts through the noise of daily market chatter, the glowing press releases from charismatic CEOs, and the soaring revenue charts that seduce millions of investors. This number tells you a story not of ambition, but of fragility. It doesn't predict how high a stock can fly. It predicts how hard it will crash. For Warren Buffett, this number isn't just a data point. It's a moral failing, a red flag that disqualifies a company from his consideration almost instantly. We are talking, of course, about debt. To the average investor, debt is a tool, a normal part of doing business. To Buffett, it is a ticking time bomb strapped to the dreams of shareholders. It is the single greatest threat to the permanent preservation of capital. His deep, visceral aversion to companies that rely on borrowed money is not a quirky preference. It is the central pillar of a risk management strategy that has allowed him to compound wealth for over half a century, surviving and even thriving through every market crash, recession, and panic the world has thrown at him. What you are about to learn is not a complex formula or a secret trading algorithm. It is a fundamental shift in perspective. It is the adoption of a simple, powerful filter that will allow you to eliminate 90% of bad investments before they ever have a chance to enter your portfolio. You will learn to see what Buffett sees, that a company loaded with debt is a servant to its lenders, while a company free of debt is the master of its own destiny. By the end of our time together, you will possess a cheat sheet, a way to use a company's debt as a direct window into its soul, its resilience, and its ultimate fate. This is the financial education that separates the amateur from the professional, the speculator from the true investor. This is the foundation of building a portfolio that not only grows but endures. The story of Warren Buffett's profound distrust of debt begins not in the gleaming towers of Wall Street, but in the decaying heart of the American textile industry. It's a story of failure. The story of a mistake that would become the single most important lesson of his career. In 1962, Buffett began buying shares of Berkshire Hathaway, a struggling textile manufacturer in New Bedford, Massachusetts. At the time, he was still operating as a pure cigar-butt investor, following the teachings of his mentor, Benjamin Graham. The idea was to find failing companies trading for less than the value of their assets. You could buy them, hope for one last puff of profit as they were liquidated, and then move on. Berkshire Hathaway was a classic cigar butt. The business was terrible. Foreign competition was crushing the American textile industry, the equipment was old, and the future was bleak. But the stock was cheap. Dirt cheap. By 1965, Buffett had taken control of the company. And that's when his real education began. The CEO at the time, a man named Seabury Stanton, had tried to keep the dying business afloat the only way he knew how, by borrowing money to buy new, more efficient equipment. It was a constant, desperate race against obsolescence, funded by debt. Buffett, now at the helm, found himself trapped. The textile business was a ravenous monster that consumed capital. Every dollar of profit it managed to eke out had to be immediately reinvested into new looms and machinery just to stay competitive. It was a capital-intensive nightmare. There was no free cash flow, no money left over for the owners. The business was in a perpetual state of struggle, and its obligations to its lenders and its need for capital expenditures were a constant, suffocating weight. He saw firsthand how debt acts as an anchor on a struggling business. When times were good, the profits were just enough to service the debt and buy the next round of equipment. But when the industry hit a downturn, which it frequently did, the interest payments didn't stop. The bank didn't care that sales were down. Their check was still due. This fixed cost, the interest on the debt, was a merciless taskmaster. It turned a small operational loss into a catastrophic financial crisis. It pushed the company closer and closer to the edge of bankruptcy. Buffett poured money from his other, better investments into the textile business just to keep it alive, a decision he would later call a $200 billion mistake when factoring in the opportunity cost of what that money could have become. One of the companies Berkshire acquired during this period was Dempster Mill Manufacturing, a maker of windmills and farm equipment. It was another cigar butt, another terrible business. It was losing money hand over fist. Buffett installed a new manager, a ruthless cost-cutter named Harry Bottle. Bottle did everything right. He slashed inventory, sold off unnecessary assets, and squeezed every drop of efficiency out of the operation. He managed to free up a significant amount of cash. But the underlying business was still awful. It was still in a brutally competitive industry, and any attempts to innovate or expand would have required taking on more debt, throwing good money after bad. The experience with Berkshire's textile mills and Dempster Mill taught Buffett a visceral lesson that no textbook ever could. Debt, in a difficult business, is a death sentence. It removes all flexibility. It forces you to make short-term decisions just to survive. It transforms the business from a vehicle for generating shareholder wealth into a machine for paying interest to bankers. He finally shut down the last of the textile operations in 1985. The ordeal was over, but it had forged in him an ironclad conviction. He would never again willingly put himself in a position where the survival of his enterprise depended on the mercy of a lender. He had learned the foundation of his fear. Debt was the ultimate enemy because it could take a mediocre business and turn it into a disaster, and it could take a good business and make it fragile. It was the one force that could guarantee a permanent loss of capital, the one sin in investing that he would never forgive. This deep-seated aversion to corporate leverage is a powerful and productive application of one of the most fundamental principles in behavioral science, loss aversion. First identified by psychologists Daniel Kahneman and Amos Tversky, loss aversion describes our tendency to feel the pain of a loss approximately twice as powerfully as we feel the pleasure of an equivalent gain. If you find a $100 bill on the street, you'll feel good. If you lose a $100 bill from your wallet, you'll feel absolutely terrible. The emotional impact is asymmetrical. For most investors, this psychological quirk is a portfolio destroyer. It causes them to panic and sell during market downturns, crystallizing a temporary paper loss into a permanent real one. They sell at the bottom because the pain of seeing their account value drop any further becomes unbearable. They are reacting to the volatility of stock prices. But Buffett has harnessed this same psychological force and aimed it at a far more dangerous target. He isn't afraid of a stock price going down. He is terrified of the underlying business going to zero. His loss aversion is focused not on market fluctuation, but on the risk of bankruptcy, the ultimate and permanent loss of capital. And what is the single greatest accelerant of bankruptcy? Debt. A company with no debt can survive years of losses, recessions, and mismanagement. It may not be a good investment, but it will likely survive. A company with a mountain of debt can be tipped into insolvency by a single bad quarter. The debt acts as a massive magnifying glass for any operational problem. It takes a small crack in the business and shatters the entire foundation. Buffett's genius is in recognizing that debt fundamentally changes the probability distribution of outcomes. For a debt-free company, the worst-case scenario might be years of stagnation. For a debt-laden company, the worst-case scenario is always a 100% loss for shareholders. The lenders get the assets, the equity holders get wiped out. By making the avoidance of debt a primary filter, Buffett is essentially structuring his entire investment process to sidestep the most extreme negative outcomes. He is playing a game where he can't be knocked out. He can underperform for a year or two, but he can never lose everything. This cerebral application of loss aversion is a form of risk management that operates at a level far deeper than simply diversifying a stock portfolio. It's about ensuring the very businesses you own are, themselves, indestructible. He is overriding the common investor's fear of price volatility and replacing it with a far more rational fear of business failure. It's a profound mental switch. The amateur fears the stock ticker. The professional fears the balance sheet. To translate this fear into a practical tool, you can use a simple but powerful mental model, the servant versus master framework. Before you invest a single dollar in any company, you must first ask the most fundamental question: who is the true master of this enterprise? Is it the shareholders, represented by a management team with the freedom to act in their long-term best interest? Or is it a consortium of bankers and bondholders, to whom the company owes its primary allegiance? A business should be a servant to its owners. Its purpose is to generate cash for them. When a company takes on significant debt, that relationship is inverted. The business, its management, and its shareholders all become servants to the lender. The first and most important slice of every dollar of profit no longer belongs to you, the owner. It belongs to the bank in the form of an interest payment. To make this abstract concept concrete, you need to perform a simple three-step analysis. Step 1 is to find the company's most recent quarterly or annual report. Go to the income statement. Find the line item called Operating Income, or Earnings Before Interest and Taxes, also known as EBIT. This number represents the profit the business generated from its actual operations before any financial costs. Then find the line item called Interest Expense. Step 2 is to calculate the interest coverage ratio by dividing EBIT by the interest expense. This ratio tells you how many times over the company's operating profit can cover its mandatory interest payments. A high number is good. A low number is a blaring red siren. Buffett likes to see a ratio of at least 5, but in reality, his favorite companies often have no interest expense at all. A company with an interest coverage ratio of 2 is walking a tightrope. It means that a 50% drop in its operating profit would leave it with exactly $0 to pay its lenders, a scenario that quickly leads to bankruptcy. Step 3 is the crucial mental stress test. Do not accept the current earnings as a given. Imagine a severe recession. Imagine the company's biggest customer goes bankrupt. Imagine a new competitor enters the market. In your mind, slash the company's operating profit by 30, 40, or even 50%. Now recalculate the interest coverage ratio. Can the company still comfortably make its interest payments? If the answer is no, you have identified a fragile business. You have found a servant, not a master. This simple framework, which takes no more than 5 minutes, moves you from being a passive stock picker to an active risk manager. It allows you to screen out the vast majority of companies that are structurally unsound, protecting your capital from the hidden risks that lie buried in the footnotes of a financial statement. The path of the 99% of investors is paved with the wreckage of companies that embraced the opposite philosophy, the growth at any cost trap. This is the seductive idea that market leadership and rapid expansion are the ultimate goals, and that debt is simply the fuel required to get there. The modern poster child for this catastrophic mindset is WeWork. The story of WeWork is a masterclass in how a compelling narrative can completely obscure a terrifyingly fragile financial reality. The company had a charismatic founder, Adam Neumann, who wasn't just leasing office space. He was, in his own words, elevating the world's consciousness. Investors, including some of the most sophisticated venture capital firms in the world, bought into this story hook, line, and sinker. They poured billions of dollars into the company, valuing it at an eye-watering $47 billion at its peak. They were mesmerized by the revenue growth. The company was expanding at a dizzying pace, opening new locations in cities around the globe. The WeWork logo was everywhere. It felt like the future, but underneath this glittering facade of growth was a business model built on a mountain of debt and financial obligation. WeWork's business was simple. It took on long-term leases for office space, on the hook for rent for 10 or 15 years. Then it would renovate those spaces and rent them out on short-term contracts, often month-to-month, to freelancers and startups. This created a massive asset-liability mismatch. Their expenses were long-term and fixed, while their revenues were short-term and variable. To fund this rapid expansion and the costly renovations, the company took on billions of dollars in traditional debt. The interest payments were staggering. The company was hemorrhaging cash, losing nearly $2 for every $1 of revenue it brought in. Most investors, caught up in the hype, ignored this. They focused on the top-line revenue growth and the visionary story. They were practicing the antithesis of Buffett's approach. They didn't ask who the master of the business was. They were blinded by the charisma of its public face. When the company tried to go public in 2019, its financial statements were finally exposed to the harsh light of public scrutiny. The investment world collectively recoiled in horror. The house of cards collapsed. The IPO was canceled, the founder was ousted, and the valuation plummeted by over 90%. Shareholders were all but wiped out. WeWork was a servant to its landlords and its lenders. Its growth was a mirage, funded by borrowed money and unsustainable promises. It stands as a monumental warning. Revenue growth fueled by debt is not growth at all. It is simply borrowing from a future that may never arrive. The direct financial connection between Buffett's aversion to debt and his long-term success can be understood by thinking of debt as a permanent, quote, tax on future earnings. Every dollar a company pays in interest is a dollar that cannot be used for the things that actually create value for shareholders. It cannot be used to conduct research and develop new products. It cannot be used to expand into new markets. It cannot be used to hire more talented employees. And it cannot be returned to the owners of the business in the form of dividends or share buybacks. Imagine two identical companies, Company A and Company B. Both are in the same industry and both generate $100 million in operating profit or EBIT in year one. The only difference is their balance sheet. Company A, the Buffett-style company, has zero debt. Company B, the typical modern corporation, has a significant amount of debt and an annual interest expense of $40 million. In year one, Company A has $100 million of pre-tax profit to work with. Let's assume a 25% corporate tax rate. It pays $25 million in taxes, leaving $75 million in net income. This entire amount is added to the shareholders' equity and can be reinvested to grow the business. Company B also starts with $100 million in EBIT, but first, it must pay its $40 million in interest to the bank. This leaves it with $60 million in pre-tax profit. It pays 25% tax on that, which is $15 million. Its net income is only $45 million. In the very first year, the shareholders of Company A are $30 million richer than the shareholders of Company B. Now, let's project this forward. Assume both companies can reinvest their net income back into the business and earn a healthy 20% return on that new capital. In year two, Company A starts with its original earnings power, plus the returns from reinvesting that $75 million. Company B has a much smaller base of new capital to work with. After 10 years, the difference is not linear, it is exponential. The earnings power, the book value, and the intrinsic value of Company A will have compounded to a level that completely dwarfs Company B. The tax of interest payments creates a permanent drag on the compounding engine. This is the essence of capital preservation and wealth creation. By avoiding companies that have a senior partner called the bank, you are ensuring that 100% of the business's success flows directly to you, the owner. It is the most direct and powerful way to put the mathematical certainty of long-term compounding firmly on your side. Once you have learned to fear debt, the next step is to learn to recognize its opposite, the fortress balance sheet. This is the financial signature of a company that is not just built to grow, but built to last. It is a business that is financially invincible, capable of weathering any economic storm and exploiting the weaknesses of its less prudent competitors. There is no better case study in identifying such a fortress than Buffett's 1973 investment in the Washington Post Company. The timing of this investment is crucial. The early 1970s were a period of immense turmoil. The country was mired in the Vietnam War, reeling from the Watergate scandal, and facing rampant inflation. The stock market was in the midst of a brutal bear market that would see valuations cut in half, and newspapers were considered a dying industry. Television was the ascendant media force, and investors were fleeing from traditional print businesses. It was a time of maximum pessimism. But Buffett, performing his detailed investment research, saw a completely different reality. He looked past the screaming headlines and the fearful market sentiment and went straight to the company's financials and its core business fundamentals. The Washington Post Company, led by the formidable Katharine Graham, was not just any newspaper. It owned the dominant paper in a major political and economic hub, giving it immense pricing power with advertisers. This was its competitive moat, but the true source of its invincibility was its balance sheet. The company had virtually no long-term debt. It was a cash-generating machine. While other newspaper chains had borrowed heavily to expand and were now struggling to make their interest payments in a tough economy, the Post was a financial fortress. It gushed cash, far more than it needed to run the business. This financial strength gave Katharine Graham and her management team incredible flexibility. They didn't have to answer to bankers. They could make decisions with a time horizon of decades, not fiscal quarters. They could invest in their journalistic talent, weathering any short-term costs, which ultimately enhanced their brand and their moat. They could buy back their own stock when it was cheap, increasing the ownership stake for the remaining shareholders like Buffett. And they could acquire other businesses, using their pristine balance sheet as a strategic weapon. Buffett invested over $10 million, buying a significant stake in the company at a price that valued the entire enterprise at around $80 million. He knew he was buying a dominant business with a brilliant manager at a time of peak fear. But the bedrock of the investment, the thing that allowed him to sleep at night, was the fortress balance sheet. He knew that no matter how bad the economy got, the Washington Post Company would survive. It had no debt to sink it. That $10 million investment would, over the next few decades, grow to be worth over $1 billion. It is a testament to the power of prioritizing solvency over sentiment, and a perfect illustration of how a clean balance sheet is the non-negotiable foundation for long-term value investing. The reason most investors miss these fortress-like companies is due to a pair of powerful cognitive biases, the simplicity bias and the availability heuristic. Our brains are wired to conserve energy. We prefer simple stories over complex analysis. The stock price, a single, constantly updating number, is seductively simple. A news headline about a company's hot new product is easy to grasp. A CEO's confident interview on television is compelling. These pieces of information are readily available and emotionally resonant. This is the availability heuristic in action. We tend to overweight information that is easy for our minds to recall. A balance sheet, on the other hand, seems complicated. It's a grid of numbers with unfamiliar terms like accounts receivable, goodwill, and accrued liabilities. Faced with this complexity, the brain of the average investor simply shuts down. They revert back to the simple, available information, the story, and the stock price. They might glance at the income statement to see if revenues are growing, but the balance sheet, the true scorecard of a company's financial health, goes unread. Buffett's approach is a conscious and disciplined effort to overcome these biases. He recognizes that the most valuable information is often the information that is hardest to process. But his true genius is in simplifying that complexity. He's not running 100 different financial ratios. He is performing a form of financial triage, looking for a few vital signs that tell him whether the patient is healthy or on life support. He's looking for simplicity on the balance sheet itself. Does the company have a thick cushion of cash? Is its debt negligible? Has its equity grown steadily over the years from retained earnings? These are not complicated questions. They are simple observations. By forcing himself to ignore the readily available noise of the market and focus on the less accessible but far more important data within the financial statements, he inverts the typical analytical process. He doesn't start with the story and try to justify the numbers. He starts with the numbers, and if they don't reveal a story of overwhelming financial strength, he doesn't even bother to learn the company's name. He is using a deep understanding of company fundamentals to protect himself from the siren song of market narratives, a discipline that is absolutely essential for long-term portfolio protection. You can apply this same discipline by using a mental model we'll call the financial moat checklist. This is a quick, 5-step process for conducting a first-pass analysis of a company's balance sheet. It's a tool that helps you move beyond the income statement and assess the actual, tangible strength of a business. Step 1. Find the company's balance sheet in its latest shareholder report. You can find this on any financial data website, or, even better, on the company's own investor relations webpage. Step 2. Look for two numbers, total liabilities and shareholder equity. Divide total liabilities by shareholder equity. This gives you the debt-to-equity ratio, a quick measure of leverage. A healthy, resilient company will typically have a ratio below 0.5. This means that for every dollar of owner's equity, the company has less than 50 cents of debt. Many of Buffett's best investments have had a ratio near zero. A company with a ratio of 2.0 or higher is playing with fire. Step 3. Look for current assets and current liabilities. Divide current assets by current liabilities to get the current ratio. This tells you if the company has enough short-term resources, like cash and inventory, to cover its short-term bills, like supplier payments and salaries. You want to see a number greater than 1.5. A number below 1.0 is a major red flag, suggesting the company could face a cash crunch. Step 4. Look for the line item called retained earnings within the shareholder equity section. Look at this number over a 5 to 10-year period. Is it consistently and smoothly increasing? Retained earnings represent the cumulative sum of all the profits the company has ever earned and chosen to reinvest back into the business. A steadily growing retained earnings account is the unmistakable sign of a durably profitable enterprise. It's the historical proof of its ability to generate cash for its owners. Step 5. Dig deeper. Don't just look at the total debt number. In the footnotes to the financial statements, there will be a section detailing the long-term debt. Read it. This note will tell you the interest rates the company is paying, when the debt is due, the maturity dates, and what conditions or covenants are attached to the loans. A company with debt that is due next year is in a much riskier position than one whose debt isn't due for 20 years. This 5-step checklist is a starting point for any serious stock analysis. It transforms the balance sheet from an intimidating wall of numbers into a clear story about a company's strength, discipline, and durability. It's your first and most important tool in avoiding bad stocks. The path of the 99% is to chase revenue while completely ignoring solvency. This is the most common and perhaps most devastating mistake in all of investing. Investors become infatuated with a company's growth story. They see revenues doubling year after year and assume they've found the next big thing. They project this growth rate out into the future and imagine the riches that await. This is exactly what happened during the dot-com bubble of the late 1990s. The narrative was that the internet was changing everything, and the old rules of valuation and financial analysis no longer applied. It was a new paradigm. Companies with no profits, and in many cases no viable business model, were coming to the public markets and achieving billion-dollar valuations overnight. The quintessential example was a company called Pets.com. It had a clever marketing campaign featuring a sock puppet mascot, and its revenues were growing at an explosive rate. In its first fiscal year, it generated $619,000 in revenue. Just 9 months later, it was on track for over $13 million. Investors went wild. They saw the growth, they loved the story, they bought the stock. What they failed to do was look at the balance sheet and the income statement with a critical eye. For every dollar of merchandise Pets.com sold, it was spending roughly $2 on marketing and shipping. It was losing a massive amount of money on every single transaction. To fund these losses, it was burning through the cash it had raised from investors at an alarming rate. Its balance sheet was deteriorating with each passing day. It had no financial moat, no fortress of solvency. It was a financial house on fire. The investors who were chasing revenue were, in effect, pouring gasoline on that fire. When the market sentiment turned in early 2000, the bubble burst. Companies that were burning cash and had no path to profitability were suddenly seen for what they were, worthless. Pets.com went from its IPO to liquidation in just 268 days. The stock went to zero. The investors who had chased its spectacular revenue growth were left with a 100% loss of their capital. It is a harsh but vital lesson. Revenue is vanity, profit is sanity, but cash is reality. A company's solvency, its ability to meet its obligations as evidenced by its balance sheet, is the foundation upon which all else is built. Without it, even the most impressive growth story is just a fantasy waiting to be exposed. The direct financial connection between a fortress balance sheet and superior investment returns lies in the concept of a, quote, margin of safety, the central principle of Benjamin Graham's value investing philosophy. A margin of safety means buying a security for significantly less than your estimate of its intrinsic value. A strong balance sheet is a powerful and quantifiable source of that safety. One of the most effective ways to measure this is by calculating a company's tangible book value per share. To do this, you start with shareholder equity from the balance sheet. Then you subtract any intangible assets, like goodwill. Goodwill is an accounting entry that represents the premium a company paid to acquire another business over its hard asset value. It's not a physical thing you can sell to pay off a creditor. What you are left with is the tangible book value, the value of the company's hard, physical assets minus all of its liabilities. Divide this by the number of shares outstanding, and you get the tangible book value per share. For a company with little or no debt, this number provides a hard, conservative floor of value. It represents what the shareholders would receive if the business were to be shut down and liquidated tomorrow. If you can buy the stock of a healthy, profitable, debt-free company at or near its tangible book value per share, you have an enormous margin of safety. Your downside is protected by the value of the company's real assets. Now, consider a company with a huge amount of debt. When you perform the same calculation, you might find that its tangible book value is negative. This means that if the company were liquidated, the value of its assets wouldn't even be enough to pay back its lenders. The shareholders would be entitled to nothing. In this case, the stock's value is based entirely on hope. The hope that future earnings will be strong enough to both run the business and service the massive debt load. There is no margin of safety, there is no hard floor of asset value. The stock is a call option on a rosy future, and if that future doesn't materialize, the investment can easily go to zero. This is the ultimate tool for portfolio protection. By focusing on companies with strong, tangible balance sheets, you are building a portfolio where, even if your analysis of a company's future earnings is wrong, you are still protected by the real, present-day value of its assets. You have a safety net that simply does not exist for investors in highly leveraged companies. The dangers of debt extend far beyond the mere risk of bankruptcy. Debt is a corrosive force that seeps into the very culture of a company, altering the way its leaders think and make decisions. It creates a tyranny of the lender, forcing executives to prioritize short-term survival over long-term value creation. It warps executive decision-making in subtle but profoundly damaging ways. A powerful illustration of this, albeit through the lens of leverage rather than traditional debt, comes from Buffett's experience after acquiring the reinsurance company General Re in 1998. Reinsurance is a complex business, but General Re had another, even more opaque division, a derivatives trading arm known as General Re Securities. This unit was engaged in writing fantastically complex financial contracts, essentially making bets on the future movements of interest rates, currencies, and stock prices. These derivatives were a form of extreme leverage. They allowed the company to take on massive amounts of risk with very little money down. The executives who ran this division were highly paid and considered financial geniuses. They were generating huge paper profits. When Berkshire Hathaway took over, Buffett began to investigate this derivatives book, and he was horrified by what he found. The positions were so complex that nobody, not even the people who had created them, could accurately model the potential losses. They were exposed to a dizzying array of counterparties, and the failure of any one of them could cause a domino effect of catastrophic losses. These contracts, he would later famously write, were, quote, financial weapons of mass destruction. The pursuit of leveraged returns had corrupted the judgment of the executives. They had taken on risks they didn't understand, creating a hidden ticking time bomb inside the company. It took Buffett and his team years and cost Berkshire hundreds of millions of dollars to safely unwind this portfolio of toxic contracts. The experience solidified his view that leverage, in any form, is a poison. It encourages a focus on short-term, illusory gains and blinds people to the possibility of low-probability, high-consequence disasters. The executives at General Re Securities weren't evil. They were incentivized by a system that rewarded cleverness and the appearance of profit, without properly accounting for the tail risk they were placing on the entire enterprise. Debt does the exact same thing. It forces a CEO to manage for the next quarter's interest payment, not the next decade's competitive position. It is a tyranny that corrupts the very soul of a business. This corruption of judgment is a textbook example of a behavioral finance concept known as the agency problem. In any public company, the executives and managers are the agents hired to act on behalf of the principals, the shareholders. In a perfect world, the agents would always act in the best long-term interests of the principals. But the world is not perfect. The agency problem describes the inherent conflict of interest that exists between these two groups. Executives may be more interested in their own salary, bonus, and job security than in maximizing long-term per-share value for the owners. The introduction of significant debt dramatically worsens the agency problem. Lenders impose strict rules, known as covenants, on the companies they lend to. These covenants are designed to protect the lender, not the shareholder. For example, a loan agreement might require the company to maintain a certain level of quarterly earnings, often measured by EBITDA, earnings before interest, taxes, depreciation, and amortization. An executive's bonus and even their job might be tied directly to meeting this covenant. Now, imagine you are that CEO. Your company is facing a tough quarter. You have a choice. You can make a long-term investment in a new research and development project that won't pay off for 5 years but could secure the company's future. Or, you can cut the entire R&D budget for this quarter. Cutting the budget will immediately boost your short-term profits, ensuring you hit your EBITDA target, satisfy the bank's covenant, and collect your multi-million-dollar bonus. The long-term damage to the company is immense, but the short-term personal benefit is irresistible. This is not a hypothetical scenario, it happens every single day in corporate America. Debt forces short-termism. The need to make the next interest payment becomes the company's primary strategic goal. The time horizon of management shrinks from years and decades to months and weeks. They become agents of the bank, not agents of the shareholders. This is why Buffett is so obsessed with finding management teams that think like owners. It's only possible to think like an owner when you are not beholden to a lender who can dictate your every move. To determine if a company's management is a true partner or merely a hired hand serving a bank, you can employ a mental model called the owner's mindset test. This is a qualitative analysis that goes beyond the numbers to assess the character and incentives of the people running the business. It consists of 3 critical steps. Step 1 is to read the CEO's annual letter to shareholders. This is arguably the most important document a company produces each year. Read it carefully. Is the CEO talking like a business owner or a corporate bureaucrat? Do they speak in plain language, admitting mistakes and explaining their strategy clearly? Or is the letter filled with buzzwords and jargon? Crucially, how do they talk about debt? Do they celebrate paying it down as a victory for financial prudence? Or do they boast about their ability to access the credit markets and take on more leverage for strategic initiatives? An owner hates debt. A hired gun often sees it as a tool to expand his empire. Step 2 is to analyze how the company uses its cash. Look at the statement of cash flows. Where is the money going? Is the company consistently reinvesting its profits back into its core business to strengthen its competitive advantages? This is what a rational owner would do. Or is it engaging in a whirlwind of acquisitions, funded by new debt? Is it buying back its own stock at inflated prices, using borrowed money to engineer a short-term boost in its earnings per share? This kind of financial engineering is often a sign of a management team that is more focused on hitting quarterly targets than on building lasting value. Step 3 is to investigate executive compensation. In the company's annual proxy statement, you will find a detailed breakdown of how the top executives are paid. This is the Rosetta Stone for understanding their motivations. Is their bonus tied to metrics that shareholders actually care about, like long-term growth and return on invested capital or intrinsic value per share? Or is it tied to fuzzy, easily manipulated short-term metrics like adjusted EBITDA? If an executive gets paid a massive bonus for hitting a short-term profit target, even if it's achieved by taking on a mountain of risk, you can be sure that is where their focus will lie. This three-part test requires more effort than simply looking up a stock price, but it is the essence of deep investment research. It allows you to find those rare management teams that truly think and act like partners, creating a powerful alignment of interests that is the secret ingredient in many of the world's greatest long-term investments. The antithesis of the owner-operator is the empire-building CEO. This is an executive archetype driven not by a desire to create per-share value for the owners, but by an egotistical need to preside over the largest, most talked-about company in their industry. Their goal is not profitability, but scale and prestige, and the fuel for their ambition is invariably debt. These CEOs are addicted to making deals. They are constantly on the hunt for the next big acquisition that will put them on the cover of Fortune magazine. They often surround themselves with investment bankers who flatter their ambitions and present them with an endless stream of potential targets. To fund these acquisitions, they use the company's balance sheet as a personal line of credit, borrowing vast sums of money to buy other companies, often at inflated prices. The classic and perhaps most catastrophic example of this behavior was the 2000 merger of America Online (AOL) with Time Warner. At the peak of the dot-com bubble, AOL was the king of the internet, a high-flying growth stock. Time Warner was an old media behemoth, owning everything from Warner Brothers Studios to HBO and Time magazine. The CEO of AOL, Steve Case, engineered a massive takeover of Time Warner, a deal born of pure hubris and a belief that his new media company could conquer the old media world. The deal was financed through a complex stock swap that was, in effect, a massive leveraging of AOL's temporarily inflated stock price. The logic was that the combination would create an unstoppable media and internet giant. The reality was a culture clash of epic proportions and a financial disaster. The synergies never materialized. The dot-com bubble burst shortly after, and the value of the combined company cratered. The AOL-Time Warner merger is now widely regarded as the single worst corporate merger in history, having destroyed an estimated $200 billion in shareholder value. It was a deal driven by ego, not by business logic. Steve Case built his empire, but it was an empire built on sand. This story is a powerful warning against investing in companies led by serial acquirers who use debt to fund their conquests. Empire building almost always leads to value destruction for shareholders, as the CEO's focus shifts from running the business efficiently to simply making it bigger. The financial metric that cuts through the fog of this kind of corporate empire building is the distinction between return on equity, ROE, and return on invested capital, ROIC. This is a critical concept for any investor who wants to understand the true quality of a business. Return on equity is a very common metric. It is calculated by dividing a company's net income by its shareholder equity. It tells you what percentage return the company is generating on the money the shareholders have invested. On the surface, it seems like a great measure of profitability. The problem is that ROE can be easily manipulated and artificially inflated using debt. Let's imagine two companies, Company A and Company B. Both need $1 million of capital to run their business. Company A, the Buffett-style company, funds itself entirely with $1 million of equity from its owners. It has no debt. Company B, on the other hand, funds itself with only $100,000 of equity and borrows the other $900,000 from a bank. Both companies generate $150,000 in operating profit. Company A has no interest expense, so its pre-tax profit is $150,000. Its ROE is $150,000 divided by 1 million or 15%. Company B has to pay interest on its debt, let's say at a rate of 10%, which amounts to $90,000. Its pre-tax profit is only $60,000. But its equity base is also tiny, just $100,000, so its ROE is $60,000 divided by 100,000, or a whopping 60%. An unsophisticated investor, looking only at ROE, would conclude that Company B is a far superior business. But this is a dangerous illusion. Company B is a fragile, highly leveraged entity. A small dip in its operating profit could wipe out its earnings entirely and put it at risk of bankruptcy. Return on invested capital, or ROIC, provides a much truer picture. ROIC measures the return a company generates on all the capital it employs, both debt and equity. For Company A, the ROIC is 15%. For Company B, its operating profit of $150,000 divided by its total capital base of $1 million gives it an ROIC of 15%. Suddenly, the illusion is shattered. ROIC reveals that both companies are equally good at their core business operations. The only difference is that Company B has used financial leverage to create a riskier and more fragile structure. When you are analyzing a company, always favor ROIC over ROE. It is the true measure of management's skill in allocating capital and the most reliable indicator of a high-quality, durable business. Once you have learned to fear debt, identify financial fortresses, and recognize the signs of corrupted executive decision-making, you can ascend to the highest level of this strategy, using it as an offensive weapon. By keeping your own financial house in order and focusing on debt-free companies, you can turn market panics, which are ruinous for the unprepared, into generational buying opportunities. This is the predator's advantage. The ultimate demonstration of this principle was Warren Buffett's performance during the global financial crisis of 2008. In the years leading up to the crisis, a frenzy of debt-fueled speculation had gripped the world. Banks were using extreme leverage to bet on subprime mortgages. Consumers were borrowing against their homes as if they were ATMs. The entire global economy was a house of cards built on a foundation of borrowed money. Buffett, meanwhile, was patiently accumulating cash within Berkshire Hathaway. He was criticized by many on Wall Street for holding so much unproductive cash, which was earning a paltry return while the market soared. They called him old and out of touch. He was, in his own words, out of step with the times. Then, in the fall of 2008, the music stopped. Lehman Brothers, a highly leveraged investment bank, collapsed into bankruptcy. The credit markets froze. The global financial system seized up. Panic swept through the markets. Everyone was a forced seller. No one had cash. No one, that is, except Warren Buffett. Suddenly, Berkshire Hathaway was transformed from a stodgy old company into the lender of last resort for corporate America. The very people who had criticized him for holding too much cash were now lining up at his door in Omaha, desperate for a capital injection to save their companies. He received a call from Goldman Sachs, one of the most prestigious investment banks in the world. They were on the brink. Buffett agreed to invest $5 billion. But he didn't buy their common stock on the open market like a normal investor. He dictated the terms. He bought $5 billion of preferred stock that paid him a guaranteed 10% dividend, $500 million a year, backed by the full faith and credit of the U.S. government, which would soon bail out the banks. He also received warrants, giving him the right to buy $5 billion of common stock at a fixed price for the next 5 years. It was an unbelievably lucrative deal, one that was only available because he had cash when everyone else had debt-fueled fear. A few days later, he made a similar deal with General Electric, another titan of American industry that was teetering on the edge. He was not a speculator catching a falling knife. He was a financial predator calmly and rationally exploiting the panic created by the collapse of a debt-fueled mania. He was able to do this for one reason and one reason only. His lifelong aversion to debt had ensured that his own company was an impregnable fortress, overflowing with the one commodity that becomes priceless during a crisis: cash. The market panic of 2008 was a dramatic, large-scale exhibition of the psychological principles of herd mentality and fear contagion. Humans are social creatures. We have evolved to find safety in numbers. When we see others around us running for the exit, our instinct is not to stand still and analyze the situation. Our instinct is to run with them. In financial markets, this instinct is amplified. The constant stream of negative news, the flashing red numbers on the screen, and the panicked tone of financial commentators all create a powerful emotional cocktail. Fear is contagious. As prices fall, more people sell, which pushes prices down further, which creates more fear. It's a vicious, self-reinforcing feedback loop. The investors who are most vulnerable to this contagion are those who are leveraged. If you have borrowed money to buy stocks, buying on margin, a drop in the market isn't just a paper loss, it's a direct threat. Your broker will issue a margin call, demanding that you deposit more cash, or they will begin liquidating your portfolio to cover your loan. You become a forced seller. You are selling not because you want to, but because you have to. Buffett's entire operational and personal finance philosophy is designed to be an antidote to this psychological poison. By maintaining a balance sheet with enormous reserves of cash and no debt, he is structurally insulated from the need to ever sell out of fear. He is not part of the herd. He is the shepherd, watching the herd stampede off a cliff. This financial discipline gives him the psychological space to act rationally while everyone else is acting emotionally. He knows that the time of maximum fear is also the time of maximum opportunity. Because he is not infected by the panic, he can calmly assess the situation and identify assets that are being sold for far less than their intrinsic value. He is exploiting a massive, market-wide failure of rationality, a temporary breakdown in the collective mind of the investment world. His strategy is therefore as much about psychological risk management as it is about financial risk management. By building a financial fortress, he is also building a mental fortress that allows him to remain calm, patient, and opportunistic when the world descends into madness. You can build your own version of this predatory advantage by adopting what we'll call the liquidity thermometer strategy. This is a practical, step-by-step mental model for preparing yourself to act rationally during the next inevitable market crisis. It's a core principle of effective personal wealth management. Step 1 is to adjust your own personal balance sheet. You must build a significant cash position. This is your Berkshire-at-home war chest. The exact amount will depend on your personal circumstances, but it should be a sum of money large enough that it makes you feel secure, completely separate from your day-to-day emergency fund. This dry powder is not a drag on your returns. It is a strategic asset. It is the price you pay for the option to buy when others are forced to sell. Step 2 is to create a crisis watch list. This is a list of 10 to 15 truly wonderful, high-quality businesses that you would love to own but whose stocks are almost always too expensive. These should be companies with durable competitive advantages, excellent management, and, of course, fortress balance sheets with little to no debt. Do the deep investment research on these companies now, during the calm times. Know them inside and out. Step 3 is to set firm price targets for these stocks. Based on your research, determine a price for each company that you believe would represent a true bargain, a significant discount to its intrinsic value. This might be 40 or 50% below its current market price. Set price alerts for these levels using your brokerage platform or a financial data website. This step is critical because it pre-commits you to a course of action, taking the emotion out of the future decision. Step 4 is the execution. When the next market panic hits, and it will, you must cultivate the discipline to ignore the noise. Do not watch the news. Do not read the panicked headlines. Unplug from the fear contagion. Your only job is to consult your pre-prepared watch list and check your price alerts. If a great company on your list hits your predetermined bargain price, you buy. You don't second-guess it. You don't wait to see if it will go lower, you execute your plan. This model replaces the emotional, fear-driven decision-making of the herd with a calm, rational, and pre-planned process. It turns you from a potential victim of a market crash into its beneficiary. The tragic alternative, the path of the 99%, is to become the forced seller. This is the person on the other side of Warren Buffett's trades during a crisis. The forced seller comes in many forms. They might be an individual investor who, seduced by the easy gains of a bull market, decided to take on margin debt to amplify their returns. When the market turns, their small loss is magnified into a devastating one. The margin call arrives. They are forced to liquidate their holdings at the absolute worst time, selling their best long-term assets at rock-bottom prices just to cover their loan. Their dream of accelerated wealth becomes a nightmare of permanent capital destruction. The forced seller can also be a company. In a panic, a business with a weak balance sheet might find itself unable to roll over its debt, its revenues plummet, and it's suddenly facing a cash crisis. To survive, it is forced to issue new shares of stock at a deeply depressed price. This action, known as dilution, is a disaster for existing shareholders. It's like having a pizza that was cut into 4 slices suddenly being recut into 8. Your ownership stake in the business is cut in half overnight. You still own the same number of shares, but each share now represents a much smaller piece of the company. The company survives, but your investment is permanently impaired. The common thread in all these scenarios is the lack of a financial cushion. The leveraged investor and the over-indebted company have no margin for error. They are structured for a world where everything goes right. When reality inevitably intervenes, they have no flexibility, no staying power. They are at the mercy of the market, and the market, in a panic, has no mercy. They are the prey. Understanding this dynamic is a crucial part of financial education. Your goal as an investor is to structure every aspect of your financial life to ensure that you will never, under any circumstances, become a forced seller. That means avoiding personal debt, maintaining a strong cash reserve, and owning businesses that have done the same. The direct financial translation of this predatory strategy is understanding that dry powder, a large cash position made possible by low debt, is not a liability on the balance sheet, but a high-value strategic asset. In standard financial theory, cash is often viewed negatively. It creates a cash drag on portfolio returns. If the stock market is returning 10% a year and your cash is earning only 1% in a money market account, holding cash seems like a suboptimal decision. This linear thinking is what gets most investors into trouble. Buffett understands that market returns are not linear, they are punctuated by periodic, violent dislocations. The true value of cash is not its stated interest rate, it is its optionality. Cash is a call option on future bargains, an option that becomes more and more valuable as fear in the market increases. Let's quantify this. Imagine an investor who decides to stay fully invested at all times. They experience the full 10% per year return during a 5-year bull market. Then, a 50% crash happens. Their portfolio is cut in half. Now, consider a predator investor who holds 20% of their portfolio in cash during that same bull market. Their overall return is slightly lower during the good years due to the cash drag. But when the 50% crash hits, their overall portfolio only drops by 40% because their cash position is stable. More importantly, they now have a huge pile of dry powder that can be deployed into the market at its point of maximum pessimism. They use their cash to buy assets at a 50% discount. As the market recovers over the next few years, the returns on this newly deployed capital are spectacular, 100% or more. When you calculate the compounded annual growth rate over the entire cycle, the predator investor who endured the cash drag comes out far, far ahead of the fully invested one. This is the mathematical core of capital preservation and the secret to truly beating the market over the long term. It's not about maximizing gains in any single year. It's about structuring your portfolio to survive the drawdowns and having the resources to aggressively attack when opportunity arises. Dry powder is not idle cash, it is patiently waiting ammunition. This brings us to the final and most powerful pillar of this philosophy, the connection between a debt-free balance sheet and the unstoppable force of long-term compounding. Avoiding debt isn't just a defensive strategy to prevent losses. It is the single most important ingredient for creating an offensive, self-fueling growth machine. A business that is not burdened by interest payments is free to reinvest 100% of its profits, creating a virtuous cycle of growth that becomes exponential over time. The quintessential example of this in Buffett's career was his 1972 acquisition of See's Candies. On the surface, it looked like a boring business. It sold boxed chocolates in California. But Charlie Munger convinced Buffett to look deeper. See's Candies was a financial masterpiece. It had a beloved brand, which gave it immense pricing power. It could raise its prices every year to cover inflation without losing customers. This was its powerful competitive moat. But its most beautiful characteristic was its financial structure. The business required almost no capital to grow. It collected cash from customers up front and paid its suppliers later. It didn't need to build massive, expensive factories. It could open new stores with a minimal investment. And most importantly, it had absolutely no debt. See's Candies was a gusher of cash. Every year, it produced far more money than it needed to maintain its operations or fund its modest growth. This torrent of free cash, unencumbered by any interest payments to lenders, was a river of gold flowing directly to its owners, Berkshire Hathaway. The acquisition of See's transformed Buffett's thinking. He had graduated from buying terrible businesses at fair prices to buying a wonderful business at a fair price. He saw the power of a company that could fund its own growth internally. The millions of dollars in annual profit from See's became the seed capital for Berkshire's future investments. That money, which would have gone to bankers had See's been a leveraged company, was instead used to buy stakes in Coca-Cola, American Express, and other great enterprises. See's Candies became the prototype for the perfect Berkshire Hathaway subsidiary, a debt-free, high-return-on-capital business that requires little reinvestment and produces a surplus of cash to be deployed elsewhere. It was the engine at the heart of the compounding machine. The human brain is notoriously ill-equipped to grasp the power of exponential growth. We are wired for linear thinking. If you are offered a choice between $1 million today or a single penny that doubles in value every day for 31 days, most people, without doing the math, would instinctively take the million. It's the classic psychological trap of delayed gratification. We prefer a smaller, certain reward now over a much larger but delayed reward later. The penny, however, through the power of compounding, would grow to be worth over $10 million. The crucial part is that the vast majority of that gain happens in the final few days. On day 20, it's worth only $5,200. On day 28, it's finally worth more than the million. The real magic is backloaded. Buffett's debt-averse investment philosophy is the ultimate expression of choosing the doubling penny. A company that uses debt to juice its growth is like the person taking the $1 million up front. It gets an immediate, visible boost. Its earnings per share might jump. Its stock price might surge. It's exciting and provides instant gratification. But that growth is linear and fragile. A company that grows organically, funding its expansion with its own retained earnings, is like the doubling penny. The growth in the early years seems slow, almost boring. It might be ignored by a market obsessed with short-term results. But beneath the surface, the engine of compounding is at work. Each year, the base of earnings grows, and the return on that larger base gets added to the pile, which then grows even faster the next year. It is a quiet, inexorable, exponential force. By choosing companies that are not siphoning off their profits to pay interest, Buffett is ensuring that the doubling process is as efficient and powerful as possible. He is making a conscious decision to delay gratification, to sacrifice the sugar high of leveraged growth for the unstoppable, long-term power of authentic, debt-free compounding. It is a mindset that is deeply unnatural for most people, which is precisely why it is so profitable for the few who can master it. To identify these future compounding machines, you need a forward-looking mental model, a tool we'll call the reinvestment runway analysis. This framework helps you distinguish between a company that is merely stable and one that has the potential for decades of explosive, debt-free growth. The analysis involves three main steps. Step 1 is to confirm the prerequisite. The company must have little to no debt and a history of generating strong, consistent free cash flow. This is the fuel for the compounding engine. You can identify this using the tools we've already discussed, like the financial moat checklist. Step 2 is to calculate the company's owner earnings, which is Buffett's preferred measure of profitability. It's a slightly more conservative version of free cash flow. You start with net income, add back non-cash charges like depreciation and amortization, and then subtract the average annual amount of capital expenditures the business needs to maintain its competitive position. This gives you a realistic estimate of the cash the company generates each year that is truly available to the owners. Step 3, and this is the most important and most difficult part, is to assess the company's opportunities to reinvest those owner earnings at a high rate of return. This is the runway. A company might be wonderfully profitable today, but if it has no place to intelligently deploy its cash, its growth will stall. You must ask, how big is the company's total addressable market? Can it expand into new geographic regions? Does it have the ability to develop new products or services that will be eagerly adopted by its customers? Can it acquire smaller competitors at reasonable prices to consolidate its industry? A company like a regulated utility might be very stable and profitable, but it has a very short reinvestment runway. It can't simply decide to double its customer base. A young, innovative software company, on the other hand, might have a massive global market to penetrate, giving it a decades-long runway for reinvestment. The longer and wider the reinvestment runway, and the higher the rate of return the company can earn on its reinvested capital, the more powerful the long-term compounding effect will be. This analysis is the pinnacle of investment research. It shifts your focus from what a company borrows of today to what it can become over the next 20 years. The antithesis of this patient, organic compounding model is the strategy employed by many private equity firms and so-called serial acquirers. This model, often called a roll-up strategy, is built on a hamster wheel of debt. The process works like this. A company, often backed by private equity, will use a large amount of borrowed money to acquire a small business in a fragmented industry, like dental practices or HVAC repair services. They then use the cash flow of the acquired business to pay down the interest on the debt. Once they've stabilized the first acquisition, they go back to the bank, borrow more money, and buy another small business. They repeat this process over and over, rolling up the industry into a single large entity. On paper, this can look like genius. The company's revenues and reported earnings grow with each acquisition. But the entire structure is incredibly fragile. It is dependent on two things that are notoriously unreliable: a constant supply of cheap credit from the banks and a stable economy. One of the most spectacular implosions of this model was the pharmaceutical company Valeant. Led by a charismatic CEO, Michael Pearson, Valeant went on a debt-fueled acquisition spree, buying up dozens of other drug companies. Its stated strategy was to acquire drugs that were already on the market and then slash the R&D budget to zero, while simultaneously jacking up the prices of the drugs, often by thousands of %. Its stock price soared, and Wall Street hailed Pearson as a visionary. But the entire enterprise was a house of cards. It was carrying over $30 billion in debt. When its predatory pricing practices came under public and political scrutiny, its business model began to unravel. Its ability to borrow more money dried up. The cash flow from its existing businesses was not enough to service its colossal debt load. The hamster wheel stopped spinning, and the entire structure collapsed. The stock price fell by over 95%, wiping out tens of billions of dollars in shareholder value. Valeant is a stark reminder that growth created by financial engineering is not real growth. It is a temporary illusion, sustained by a constant infusion of debt. The long-term compounding machine builds value from the inside out. The serial acquirer simply papers over a hollow core with borrowed money. The direct financial connection that ties all of this together is the beautiful, elegant, and powerful, virtuous cycle of retained earnings. Let us visualize the financial flow of a true, debt-free compounding machine. In year 1, the company generates $1 billion in owner earnings. Because it has no debt, it pays $0 in interest. The entire $1 billion belongs to the shareholders. The management team, acting as prudent stewards of capital, decides to reinvest that entire amount back into the business, perhaps by opening new stores or expanding its factory. They are able to earn a 20% return on this new invested capital. In year 2, the company's earnings power is now its original profit stream plus the fruits of last year's investment. It now earns $1,200 million. And because it still has no debt, it gets to keep that entire larger amount. It can now reinvest $1.2 billion at a 20% return. In year 3, its earnings will be even higher. This is the virtuous cycle. Profits fund investments, which generate higher profits, which fund even larger investments. The growth is not linear, it is exponential. Now contrast this with a leveraged company. It also earns $1 billion in operating profit in year 1.